To be fair, the economy has been in a recession for probably 80% of the households since at least last fall. So the answer to whether we're in a recession or not, or whether it's going to start in 2023 is it's already started. We're in it. And you're starting to really see it in the retail numbers, retail sales numbers. Hello, fellow precious metals investors and economists. Welcome to the next episode of my new podcast joint venture with Chris Marcus and Arcadia Economics. So Chris gets upset when I'm not wearing a professional looking business shirt, but in honor of the French Open, which started on Sunday, I thought I'd share my favorite tennis t-shirt with everyone. Sorry, Chris. And today I wanted to give a brief review of the economy and how my view that we're already in a recession fits into my outlook, my bullish outlook for the precious metals sector. You're hearing a debate out there about whether or not the economy is in a recession or will a recession start in 2023. And I think there's a good case to be made that for most of the households in this country, the country's been in a recession since last summer. And I scrutinize economic data on a weekly basis for my Short Sellers Journal newsletter. And I happened to notice that around July or August last summer, that a lot of the hard economic data, manufacturing and even home sales, believe it or not, and retail sales data started softening up, and some of it actually started rolling over back then. And to be fair, I think the economy has been in a recession for probably 80% of the households since at least last fall. So the answer to whether we're in a recession or not, or whether it's going to start in 2023 is it's already started. We're in it. And you're starting to really see it in the retail numbers, retail sales numbers, just the general consumer numbers. A lot of the regional Fed manufacturing reports that get reported on a monthly basis. And also in the housing market, it's really starting to show up. So last week, I think a lot of you are aware that Walmart and Target reported disastrous earnings results. Well, disastrous may be a bit of an exaggeration, but their stocks got hammered. Target was down 25% after it missed estimates. And both companies reported on a year-over-year basis for the quarter about 3% revenue gains. But if you strip out inflation, just CPI inflation, which on a year-over-year basis for most of the first quarter was around 8%, that means that they're on a real basis, their revenues declined. And what that means is that if you measure what they're selling on a unit basis, they sold less units in Q1 this year than Q1 last year. And if you actually use a real inflation number, as we know the CPI inflation number is hokey, then their revenues on a real basis just got hammered. And I shared a chart in my newsletter from Walmart that showed the rise in its inventory, and its inventory is going up at basically a 45-degree angle from left to right. And according to management, the bulk of the inventory items that they can't sell right now are discretionary items. So like if you walk, I don't go into Walmart, but occasionally I go into Target, and you walk in and there's a lot of impulse items. You go there to buy something specific and you end up walking with a bag full of stuff. Well, people now are going to these stores to buy specific things, non-discretionary items that they need for their daily life, and they're not buying the discretionary items. And that's because they're basically running out of income and savings. On a monthly basis, their budgets are, for many households, actually undershooting what they spend. And you're seeing that in the consumer credit reports. Another announcement that came out earlier this week is that Amazon is looking to unload at least 10 million square feet of warehouse space. So clearly Amazon over-anticipated the strength of the economy and built way too much warehouse space, and now it's looking to unload that. Well, if it thought that the economy was going to grow for the foreseeable future and that its revenues were going to grow for the foreseeable future, it wouldn't be selling that warehouse space. It would be adding more. And then specifically for me, because I've been following the housing market since the early 1990s. And the housing market is starting to roll over, and it's starting to roll over very quickly. As an example, just yesterday, new home sales for April were reported, and they were down 17% on a seasonally adjusted annualized basis from March, and they were down a whopping 27% year over year. Now that's basically diving off a cliff. And inventory is not a factor. According to the Census Bureau, which tabulates new home sales on a monthly basis, there was 9 months of new home supply sitting at home builders. Now, to be fair, a portion of this is homes that are already have been contracted for and are under construction. However, a full 35% of that inventory is estimated to be on spec. And a lot of those homes are probably going to sit empty for a long time. And to make matters worse, you're going to start to see the cancellation rate rise very quickly. And it's already been rising. And what that means is that a portion of those homes that are in inventory and being constructed and under contract, those contracts will be canceled. And probably the most primary reason, the most foremost reason for that will be that the buyers simply don't qualify for mortgages any longer with higher mortgage rates and shrinking monthly net income, discretionary disposable income. So the reason why this fits into my outlook for the precious metal sector is that at some point this summer, I believe the Fed's going to have to shut down its supposed hawkish policy. Now, we can get into a whole conversation about how what the Fed has done so far isn't even remotely close to being hawkish. For instance, the Fed's balance sheet hasn't gone down at all. It's staying roughly near an all-time high, close to $9 trillion. And it's raised interest rates a measly 75 basis points. That's not going to attack inflation. If the Fed wants to attack inflation, it should first and foremost, the easiest thing for it to do is it's got $2 trillion sitting in the overnight reverse repo facility. This is reserves that banks have nowhere to go. So they give it to the Fed on a reverse repo rate basis, and they get paid, I think, 0.5% on an annualized basis, which might not sound like much, but when you apply 0.5% over the course of a year on $2 trillion, it turns into a big number. So if the Fed wants to attack inflation and do it effectively, it should convert that $2 trillion overnight reverse repo facility into a permanent operation repo facility and destroy that capital. And that still won't destroy all the money that it's printed since March 2020. But anyway, to circle back, I think the Fed's probably going to have to shut down its hawkish policy sometime this summer. And that's going to act like rocket fuel on the precious metal sector. And I believe precious metal sector may have already bottomed from the current pullback already. What I have here is a 1-year chart of GDX. And I know a lot of people are getting really frustrated with the performance of the precious metal sector, with the performance of gold and silver. Without getting into it, obviously a big component to the poor performance of gold and silver over the last few months is the overt manipulation that's done by central banks to support their fiat currency monetary system. But another part of the sell-off that we've seen in the precious metal sector is just in correlation with the general stock market. When the stock market started to fall off a cliff, hedge funds are large investors in mining stocks, and especially the momentum chasing ones. And when the stock market starts to go bad, they sell everything. They don't care what it is because they have to avoid margin calls. Hedge funds are highly leveraged, and in order to avoid margin calls in a falling market and try to preserve some performance, they just sell everything. And that's part of what we're seeing in the precious metal sector, and especially the mining stocks. And then finally, let's not get too greedy here. GDX ran up almost 40% from the end of January to mid-April in the space of about 2.5 months. Now, the general market audience didn't hear anything about this because they're not going to talk about that on CNBC. But if the S&P ran 40% in 2.5 months, they'd be doing naked cartwheels on CNBC and Fox Business and Bloomberg TV. So another part of what we're seeing here is just the natural cyclical correction of a market that went almost parabolic in a very short period of time. And there's going to be natural profit taking, especially when the momentum stops and it starts to go the other way. However, if you'll notice, and I don't know if you guys can see my cursor or not, because I am a beginner at using Zoom, but it looks to me like the precious metal sector may have bottomed out a couple of weeks ago. And you can see here that GDX has bounced nicely. It's run back up to its 200-day moving average. It's probably going to have a dogfight there. But I wanted to include the MACD because you can see the MACD, it's gotten extremely oversold. And if I recall from looking at the chart, the MACD is actually more oversold than it was in March of 2020. And don't hold me to that because I did show a chart similar to this in my mining stock journal, I think in the last issue, and I had done this analysis. But at any rate, you're starting to see a gentle upturn in the MACD. And I wanted to show the MACD because instead of the RSI or with the RSI, because the MACD tends to capture at extreme tops and bottoms, it tends to capture turns in the cycle better than the RSI, which is, in my opinion, more of a true short-term momentum indicator. So whether or not this is the start of the next up leg or not remains to be seen. Part of it's going to depend on what happens with the stock market. If you recall from 2008 or even from February and March 2020, when stocks start heading south, it affects everything, including the precious metal sector and the mining stocks. But if you recall, in March of 2020, the mining stocks and gold and silver started to bottom and move higher ahead of the S&P. Now the lag wasn't like really noticeable, but it was there, and it wasn't really noticeable because right away the Fed came out and started dumping trillions into the financial system, and that's what juiced everything. But in 2008, for those who were around back then and remember what went down, the mining stocks and gold and silver and the stock market all went down in tandem at the same time, especially between March and October that year of 2008. But then at the end of October, all of a sudden, gold and silver started heading north. And then a couple of days later, the mining stocks followed. And between beginning of November and the end of the year that year, 2008, the Huey index doubled in that space of time. I mean, it doubled, and then it kept going higher from there. Same thing with gold and silver. Same thing, with GDX. And at the same time, the mining stocks continue, not the mining stocks, the general stock market continued heading south and didn't bottom until late March of 2009. So that's kind of what I see happening this time. And I have no idea on timing. No one does. But I think we're probably closer to something like that occurring than we were 3 months ago, 6 months ago. And I think a big catalyst for that, and I think it's going to happen regardless of whether the Fed reverses course on its monetary policy or not. But I think a big catalyst for that will be the Fed starting to back down a little bit, because especially ahead of midterms, let's not forget about that. The Fed's not going to crash the stock market ahead of midterms. So keep that in mind. Just to put in a quick pitch for my mining stock journal, the next issue is going to be released tomorrow, and I'm featuring a handful of high risk, high return ideas that I think have been unreasonably beaten down. One of them is really not even that high of risk, and I think it's probably only a couple of years from having this project converted into a mine, and it's just absurdly undervalued relative to the theoretic value of the project as reflected in the pre-feasibility study that it has out. And the company's going to have a feasibility study completed sometime this summer. And I think that's going to help boost the stock. And there's another idea, and this thing went completely unnoticed because the press release happened on a Friday. And I would mention the name, except I like to protect my subscribers on ideas that I think are just unbelievably fortuitous at this point, thanks to the market. One of the companies I've covered for many years, it's a very small micro cap, under $10 million micro cap company, received a multi-million dollar infusion of capital from a major mining company. And I go through the details. I spoke to the CEO yesterday in depth about the whole situation. And I go through the details in depth in my newsletter. And this company is right now trading not too far below the value of the cash per share on its balance sheet. And it has some highly prospective projects, any one of which, if they show good drill results over the next several months, I mean, the stock's just going to take off like wildfire. And my personal view is that this stock has 5 to 10 times potential upside. And I do own the stock in the fund that I manage, and I've owned it for a long time. And I started accumulating shares in my personal account yesterday because it's just too cheap to pass up. And the downside is extremely limited. So at any rate, if you want more information on my newsletter, you can go to investmentresearchdynamics.com, and I've got links to both the newsletters that I publish and what's involved with them. And of course, as everyone knows, my good friend Chris Marcus runs Arcadia Economics, along with his good friend and my good friend Yara. And well, you know where to find their website because you're watching the podcast now. So I hope everyone has a fantastic Memorial Day holiday. And I look forward to chatting with everyone again in 2 weeks.
Well, thank you, Dave. Sure appreciate that. Great to get your insight as always. Love the t-shirt. Thank you for that as well. Although before we wrap up, we actually did have some deal stock news out yesterday, because as you can see here, Sierra Madre Gold and Silver has acquired the La Guitarra silver gold mine in Mexico from First Majestic Silver Corp. So two of the companies that we follow here. And as you can see, acquiring a 100% interest in the La Guitarra silver gold property. La Guitarra is a high-grade, past-producing underground mine with on-site process facility that operated up until August of 2018. And one of the highlights of the deal is that Greg Liller, who you've actually seen on the show from Sierra Madre, was formerly operating that mine, so experience with that project. Historical measured and indicated mineral resources of approximately 7.45 million ounces silver equivalent, and historical inferred mineral resources of approximately 10 million ounces silver equivalent based on over 128,000 meters of drilling. Functional and expendable 500 tons per day crushing, grinding, and flotation facility, and fully permitted for underground mining. And as you see down here, First Majestic to become the strategic and largest shareholder of Sierra Madre, as they will be getting shares of Sierra Madre for a total of 35 million. And we actually recorded a short video walking through some more of the details of the deal. And to find out a little more, well, just click on the video coming your way now.